of their forecasts to look at, when they also have the monetary policy report, that big press conference where they can kind of present why they're taking the decision and explain more about it. So generally speaking, a lot of people thought the next cut was going to come in November. But given where the Fed have been recently, given that there was the speculation about that jumbo cut, a lot of people thought maybe it might move forward. Worth saying, though, as you mentioned earlier, the inflation data, I wouldn't say it's kind of terrifying by any means, but there was a little sign there. If you looked at core inflation yesterday, that was a bit higher than expected. It actually rose, and it was higher than expected. So does that mean that they were still a bit cautious, still a bit nervous about inflation?
Point, of course, Ed, with the context of all of this, is that the Bank of England obviously has recently cut last month, something that we have to remember when we talk about what the Federal Reserve did yesterday. Odd, actually, for the Federal Reserve to kind of be the last of the big Western central banks to turn the corner. But it is a big moment. Now, all of those central banks, the Fed, the most important, are saying that we think the worst of inflation is behind us. And they said that kind of resoundingly so yesterday.
Yeah, it is a moment, isn't it? I mean, it was the European Central Bank first of all, then the Bank of England, and now the Federal Reserve. Everyone knew that they were kind of preparing to cut, but of course they didn't know how much they were going to cut by. The fact that it was a bigger cut than expected, well, that was the surprise that we had, although speculation was growing about that. I mean, it's interesting just to kind of look, listening to Jay Powell, the chairman there, who you saw a moment ago announcing that decision, keen to say that they think that they have inflation, if not under control, that they're starting to kind of bring that under control, at least to the extent where they can cut interest rates, but also concerned about the labour market as well. So concerned that the US labour market isn't looking as strong as it could be, which in turn is going to make people worried that, are you seeing some recessionary signs in the US? The fact that it was a bigger move than expected has two angles to it, doesn't it? Investors to some extent are going to look at that and say, great, money is cheaper. But on the flip side, what does that spell about the economy? Mm-hmm. Now, here in the UK, it's worth saying, even if there is a hold, so even if rates stay on hold, what we do get is a little bit more of a hint about where they might go in the future. So we get the minutes. We look at the voting record there, as indeed we could do for the Fed last night. We also look at, whether there are particular lines in there about how strong they think the economy is. So there will be other data besides that decision. Mm-hmm. And who knows? And I think hopefully we'll also hear a little bit from Andrew Bailey either way, whether it's a cut or indeed a hold. We'll hear a bit more, so we get a bit more detail.
It's interesting, Ed, because, the last two times the Federal Reserve has done a double cut, a jumbo cut, it has then preceded a recession emerging in the months that followed, though, as you're saying, that's not actually what people expect based on the data at the moment in the US. But there's an added little bit of nuance to all of this, if we're getting geeky about it, which is that the Federal Reserve has a dual mandate. They have to focus on inflation and unemployment. And if you listen to the press conference last night, it's sort of a hint there from Jay Powell that he's willing going forward to focus a little bit more on employment and the broader economy, and if necessary, let inflation get a little bit higher than you might otherwise expect. Andrew Bailey doesn't have quite the same flexibility. His mandate is simple. It's inflation. And that also might explain in coming weeks and months why the Federal Reserve might cut one or two times more or faster than the Bank of England.
Yeah, and the interesting thing, kind of thinking back to when interest rates were first raised, okay, so a few years ago, when that inflationary period really began, the Bank of England was actually relatively early to start raising interest rates, but it only did it quite slowly. So is there an analogy here where the Bank of England actually was early-ish to start cutting, at least they were earlier than the Fed, but they're doing it more gradually, whereas the Fed is cutting more quickly? As you say, maybe that's partly down to the mandate, although in practice, the Bank of England does have a clearer order. It needs to keep inflation to a very specific range. But in practice, that's never really held them back from kind of working around that mandate. I think, the big question now, there is a big difference here. In Europe, we've had higher inflation. Okay, you've got a bigger challenge now with energy prices. The growth hasn't been quite as strong here. In the US, it's a very different story. Growth has been a bit stronger. Inflation hasn't been quite so high. It's followed a slightly different curve. And as a result of that, you've got divergent stories. And that's a little bit unusual as well. Normally, people look at what the Fed are doing and then they can apply exactly the same story over here in Europe. But I don't think that'll necessarily be the case this time around, just because of that big divergence in energy prices, which, as we've learned in the last few years, that feeds into everything else. And energy prices right now in Europe are really high, whereas in the US, they are considerably lower. And in the US, you're seeing this reindustrialization, whereas here in Europe, many countries, Germany, the UK included, are still deindustrializing. So you're seeing manufacturing going down because they just can't really kind of make ends meet at the moment, given those higher energy prices. So kind of interesting in terms of that economic divergence, which isn't always the case.
As always, great stuff, and we'll see you again towards the top of the hour as we build up to that interest rate decision, and of course at the top of the hour when it crosses, and for full reaction to it. Ed Conway there for us. Let's bring in now Liz Martins. She's senior UK economist at HSBC. Liz, great to have you join us. What is your expectation for the Bank of England at noon?
Well, I'm nervously expecting a hold decision. So that's been our forecast for a while, that like the European Central Bank, the Bank of England cut in August, but then paused, and then they'll cut again in November. So take it very, very steadily. But I say nervously because, you know, the Bank of England has surprised us in the past. They don't mind surprising the market. They don't mind if the market thinks one thing and they do another. So there is always that small possibility, like Ed said, about 15-17%, that they do go ahead with a follow-up cut.
Why are you nervous? Just because it might mean our interview here is slightly inaccurate to our viewers, or because another cut would reveal something about what they're thinking about the UK economy that would be worth being nervous about?
No, it's more the former, to be honest with you. I don't think a cut would necessarily indicate that they're particularly worried about growth. In fact, it would indicate, I think, the opposite, that they are getting more confident about inflation coming down. And, you know, yesterday's numbers were a mixed picture, but the bit that they've been really focused on, services inflation, if we leave out airfares, and anyone who booked a holiday in August can probably agree with the fact that those were very high. If we strip those out of the calculation, you know, it was looking a lot better. So I think if there is a cut today, it's not because they're very, very worried about growth. In fact, the economy's been in decent shape through 2024. It will be more in testament of being more confident about inflation.
And Liz, talk to us about how quickly the effects of a cut or not filter through to the economy as a whole. I mean, if we do now get a couple more cuts, whether it's today or in the meetings left this year, does that almost certainly mean a recession is avoided and that growth, in fact, will accelerate, or is it uncertain and does it take longer?
I would be very hopeful that a recession would be avoided. You know, one thing that struck me is how much the housing market has responded to just one single cut being delivered in August. You know, on the back of that, we saw the RICS housing market survey jump. We saw the housing asking prices doing double in September what they normally do. And as we move into 2025, the net change in people's mortgage payments, if we look at everybody overall, is going to be downward. So there's a few people still refixing onto higher interest rates, but there's a lot of people who are on a floating rate or who fixed 2 years ago who will be now refixing their mortgage onto a lower interest rate. And that means, of course, they'll have a little bit more money to spend every month. So I do think, yeah, interest rate cuts will support growth, and growth is already in decent shape. We're not on the verge of a recession in the UK.
So Liz, what is your expectation for the rest of this year? Whether we don't get a cut today or not, do you think there'll be a cut, one more cut, two more cuts throughout the rest of the year? And what's the forecast for growth this year and next?
So we definitely forecast a cut in November. By the time of November, we'll have seen the budget, and we'll also have seen the US election. So I think, you know, that will allow the BOE to really assess the lay of the land, and I think they will cut on the back of that. Then there's a possibility, of course, that they cut again just before Christmas. It's not our central case, but it's certainly possible, and we'll be looking for clues in the statement today. As far as growth, look, we've had a really strong pace of growth in the first half of this year, which I think, to be honest, was unsustainable. So growth of 0.7 in Q1, 0.6 in Q2, you know, that was on the back of last year's recession, and I don't think we're going to sustain that. But can we keep growing at a reasonable pace, supported by interest rates coming down and real incomes rising? Yeah, absolutely, I think we can.
Liz, thanks so much for joining us. Good to see you.
Thank you.
Well, how are lenders feeling about interest rates at the moment? Let's take a look at how mortgage rates are looking today. Well, the average 2-year fixed rate residential mortgage still rests above 5% on 5.47. That's unchanged from yesterday, while the average 5-year fixed residential rate is 5.14%. Joining me now is Ryan Etchells, Chief Commercial Officer at the lender Together Money. Thanks so much for joining us, Ryan. There are rates that are lower than that, though, available in the marketplace?
Yeah, we're seeing a reaction from lenders reacting to the swap rates that are looking at predictions of base rate. And as we've all been saying on the call, whether there's a hole today or not, what's definitely coming through is downward movements as we head into the end of 24 and into 25. And lenders are reacting to that. They're expecting those base rate falls coming and the pricing so that customers can take advantage of those future falls that are coming through.
And are we seeing a lot more volume of mortgages, whether new purchases or refinancing off the back of that first rate cut in August?
Absolutely. So mortgage completions are up, mortgage applications are up, house prices remain steady and improving as well. But it's not just the data that tells you. You can see now a lot of optimism in the economy, a lot more for sale signs up, a lot more skips on driveways, people looking to improve the property or looking to move on. You can definitely feel the optimism that's building as we head into a downward rate environment. What
about on the flip side, for those people that are saving money and wanting to save money? Have banks adjusted what they're offering savers as quickly as they can?
I think it's definitely coming through. I think it was a little bit slower on the savings side than it was on the lending side, but it's definitely coming through. All things balance around base rate, and we're starting to see that balance come through now, definitely, yeah.
In terms of the action you said that we're seeing in terms of refinancing and mortgage approvals, what are we looking at in terms of loan to values? Are there worrying signs there in terms of people potentially taking more risk than they should, or is it looking relatively reassuring?
No, I think the financial sector's learned those lessons from back in 2007, 2008. We're not going to see those high LTV positions. We're hoping for some government support over the coming years, whether that be Help to Buy schemes that we've seen in the past or other schemes that look like that as well as an appetite to increase house building. That's the actual factor that we need to improve. We need to start building more property. The demand for house buying and the demand for rent is still as strong as ever.
I mean... Oh, sorry, I thought you were finishing. I was just going to say, clearly rates coming down is encouraging for those people with mortgages or looking to purchase with a mortgage in the future, but rents are still pretty high.
Yeah, we've seen a turbulent couple of years in the buy-to-let sector. There's been a lot of legislative change, a lot of taxation changes. So we've been seeing buy-to-let landlords cope with that in different ways. But we're now starting to see that buy-to-let sector coming back. And it's very important that we have a strong sector of landlords, professional landlords that are now coming through, because the demand for tenancy, the demand for people that want to live in good quality homes is there more than ever. So, lenders are there to support people that are looking to provide that housing for tenants and make sure that we've got a longer term view. Again, coming back to that house building point, we need a longer term view on how we're going to hit the higher targets of house building that this country really needs.
Ryan Etchells, thanks so much.
Thank you.
Time for some other business stories now. And the high street fashion retailer Next has raised its annual profit outlook for the second time in less than 2 months. The group reported a 7.1% rise in underlying pre-tax profits to £452 million for the first 6 months of the year, thanks to increased sales overseas and a rebound in UK trading in recent weeks. Ocado Retail has increased its revenue guidance for the year after it reported a sharp rise in turnover in the third quarter of the year. The online supermarket said revenue rose 15.5% year-on-year to £658 million. Britain's biggest water utility is lining up court dates to push through a massive debt restructuring that could keep it out of government hands. Sky News has learned that advisors to Thames Water have approached a broad group of investors, including Apollo Global Management and Golden Tree, to gauge their appetite to participate in a multi-billion-pound rescue fundraising. Well, let's have a look at markets. They're rebounding pretty strongly in light of central bank action. Of course, central bank action last night in the US. Interestingly enough, though, Wall Street did close lower yesterday. Not too much, down by about 1/3%. But the mood changed overnight, both in US futures, but also in Asian trade. As you can see, Asian trade resoundingly positive. The Nikkei, which has been soft of late in light of a stronger yen, is higher, even though that theme continues of a stronger yen and a weaker US dollar, leading the charge there in Asia, up 2%. Europe pretty positive as well. The FTSE's up more than 1%, the DAX up 1.5%, France up a full 2% as that positivity from the 0.5% rate cut in the US carries through to European trade. The FTSE there for you up 1.3%. Currencies, a lot of action there, of course, in light of all the central bank changes. And the British pound holding there at 133.2. So 133 or so, up a full 0.5%. And the theme is pretty common across the board, with the dollar weakening, other currencies strengthening after that 0.5% rate cut. Crude also benefiting, as are other commodities. Brent up to 74. We're also seeing WTI in the US up about 0.5% to 71, and gold hitting another record high, $2,612 an ounce at the moment, up 0.5%, a record high there. And US futures, as I mentioned, also pointing to a very strong open. The Nasdaq up 2.1% in the futures, a huge positive move at this stage of the morning. Let's discuss all of this with Patrick Farrell, Head of Research and Chief Investment Officer at Charles Stanley. Thanks so much for joining us, Patrick. Good to see you. Double cut, a jumbo cut, as we've been calling it, 0.5% from the US yesterday. Is that unreservedly positive for equities?
Look, I think we have to take it in light of a couple of different scenarios. And I think this is what the market was trying to discern, particularly in the press conference, because if the Fed were cutting by 50 in response to a recession fear, that's not good for equities, because we will see, obviously, more concern coming through, lower profits, very difficult sort of market environment more generally. However, if it was cutting for insurance purposes to actually make sure that, we want to have a soft landing and we feel quite strongly that the economy is actually doing well, then that's a different scenario. That is actually quite good for markets, because typically when you look at an insurance cut of this particular size, following the next sort of 12 months, you could probably see 20% in terms of some of the historical averages for these insurance cuts being reflected in equity share price performance. However, if it is more of a recessionary type fear, then equity markets basically go sideways for the next sort of 12 months.
Is it unreservedly bearish for the US dollar, and how does that then inform the other things you're doing for clients in their portfolios?
It is a very, very good question, but I think when you start to look around the world and look for pockets of economic strength, it's very, very difficult to find them. So looking at a 2% growth rate in real terms in the US, and I compare that around the world, it's difficult to find any sort of matches. So the US dollar, as you saw last night, had a very sort of funny reaction. So it should have probably weakened an awful lot more, but it ended up opening down quite a bit and then rallied quite aggressively. And now it's sort of basically where it started the day. So I think the US dollar is still a little bit of a quandary for markets around the world, but from the growth differential and still from an interest rate differential, the US still looks quite attractive under that sort of format.
What's the view towards gold there at Charles Stanley, which hit another record high today?
So commodities in general have done extremely well, as you highlighted. We've seen a bounce back in oil, we've seen a bounce back in copper, and gold and other precious metals, including silver and palladium, have all done actually really quite well. And I think that this is a function where central banks will continue to sort of buy, and it actually is providing a little bit more of a hedge in terms of some of the geopolitical activity that we're also seeing. And so there are a lot of different factors that actually contribute to the sort of gold price performance. But as we get more certainty, and this gold is very responsive to the degree of uncertainty in the marketplace, but I think with the Fed move last night, it actually has provided a degree of certainty as to what central banks can do and where their sort of balances are at the moment. And I think that could see the actual gold price start to peter sideways a little bit more.
Patrick Farrell from Charles Stanley, thank you.
Thanks.
Still to come here on Business Live, cut or hold will continue the build-up to the Bank of England's interest rate decision due at midday in 8.5 minutes. We'll be right back.
Weeknights on Sky News.
This is your chance. Tell people. Welcome to the Politics Hub.
Our police force has apologised. If you want to find out about Grimsby, you come to the docks.
I'm live in Jerusalem.
Are you not concerned that that could lead to all-out war?
Hello there, good evening. There are fears of an upsurge in violence. What's at stake here?
You are watching the press preview, a first look at the front pages as they arrive.
I'm David Blevins, and I'm Sky's senior Ireland correspondent. I'm based in Belfast, a city transformed by peace, but still struggling with its past. Politically, the two sides are as far apart as ever, and it's over that question of who has sovereignty in Northern Ireland, the very issue that's been the source of tension here for generations. It takes 60 minutes to cross the Irish Sea. It took the British monarchy a century. I've spent 25 years reporting the journey from conflict to peace.
The political parties of Northern Ireland have reached agreement.
We help you understand the world with us.
Today, we have reached an agreement with the Conservative Party on support for government in Parliament.
We already know what the government gets out of this deal. What exactly does the DUP get out of it? Well, £1.5 billion. Welcome to Winterfell. It's an iconic location in this globally acclaimed drama. Ophelia was the most powerful hurricane this far east in the Atlantic on record. You can't live in a place like this and not appreciate the environment.
I say, bring it on.
With America divided and tensions running high, get ready for an election like no other.
Join our teams as we follow the campaign trail as America decides.
We will win, win, win.
Get closer to the action this US election with full reaction and analysis.
Sky News, the full story first.
Traveling is not just about the destination. It's also about how you get there. Fly Emirates, fly better. Fly Emirates, fly better. Thank you.
We're just a few minutes away from the Bank of England interest rate decision. Let's bring in our economics editor, Ed Conway, once again to build up to this decision. Ed, just remind us where interest rates stand at the moment and what the expectation is.
So we're at 5%. They came down, obviously, from 5.25%. And the expectation at the moment is that they are not going to be cut today. At least that's what kind of just under 20% of the kind of the weighted average of what investors expect is. But you never know, really. I mean, that's the interesting thing about these moments. There have been points, certainly, in the last few years where the bank has surprised people. It's surprised people by doing nothing sometimes. Sometimes it's surprised people by doing stuff. For instance, you know, when it came to deciding to raise interest rates in the first place, a lot of people thought they would move sooner. They didn't. And then they surprised people by moving on in a December, which is not a month where they typically tend to change rates. Normally, the months where they do tend to do things are the same months where they also have a big forecast coming. So they've got 4 of these forecasts a year. It used to be called the inflation report. Now it's called the monetary policy report. And this is not one of those months, OK? So it's not their big forecast month. That being said, you never really know. You never know until that decision has arrived. And you've got new membership in the MPC at the moment. You've got different dynamics playing out on this committee. Remember, it's a committee of 9 people who are taking the decision. So you never quite know which way it's going to fall. So there is a little bit of tension. I have no clue as to where it's going to go. I would say I suspect probably they'll hold. But there's always a part of you in these moments, in the run-up to the decision, that feels a little nervous about it. So we'll see. It's close.
And there's certainly a lot of jeopardy as well on how those 9 votes will go, and that will be something that will be very interesting to pass through as to what it indicates might come in the meetings to follow. Ed, thank you. Ed's going to stick close for us. As we leave you for a quick break ahead of the decision, the pound is higher by 0.4%, and the FTSE 100 is higher by over 1%. We'll take a very quick break. We'll be back with the Bank of England interest rate decision in a couple of minutes.
Hello, good afternoon. Breaking news at midday. The Bank of England's Monetary Policy Committee are meeting to decide what will happen to UK's interest rates. Let's cross to our economics and data editor, Ed Conway. Ed, currently at 5%, what have they been considering?
Well, the decision is just about to come in. They've left them on hold. So 5% is the decision, stays at 5%. That decision just through just now. And I would say not really a surprise in as much as that is the way that most economists thought they were going to go. The focus now is going to be on the next meeting, which comes in November. That is the meeting where I think everyone thought they were going to start cutting interest rates. Let's recall, though, first of all, that they did begin cutting interest rates back in August. So they have begun on this process of them coming down, but they're coming down relatively gradually. So a 0.25 percentage point cut happened in August. They were down from 5.25 to 5%. This time around, no change, but the expectation is next time around in November, it looks like there would be another cut as well. There had been a bit of speculation because the US central bank, the Federal Reserve, cut interest rates last night by more than expected, by a full 0.5 percentage point. But nonetheless, the bank had been expected to leave things on hold, and that is indeed what's happened. Just looking at the breakdown, so we've got the minutes through from that meeting. What happens this time around? There's no press conference or anything, although we may get a word from Andrew Bailey, the governor, a little bit later on. There's no press conference, but we do get details of the minutes to this decision. And it looks like one of the members of the 9-person committee voted for a cut in interest rates, whereas 8 of them voted to leave them on hold. So it's an 8-1 vote to leave interest rates on hold. And a lot of people will look at that and say, more or less what we expected. We think they're still going to be cutting interest rates in the future, and then again and again down towards potentially kind of 3.5% or so in the next 2 years or so. But it's a gradual process, and obviously, even at 3.5%, those interest rates are going to be considerably higher than those levels that we might have become slightly accustomed to following the financial crisis, when they were down basically at 0 or just above 0. So the decision today, not a surprise, to leave interest rates on hold at 5%. And now the focus will be on what happens next. Do they cut, as expected, down to 4.75% in November? Do they speed up the pace if indeed it looks like the economy needs it? Worth saying at the moment, the economy not enormously strong. I mean, the first half of the year was pretty strong, but the GDP numbers more recently not enormously strong. And certainly some people are looking at the labour market, looking at unemployment and saying there are signs of strain from higher interest rates. So it might well be time for the Bank of England to start thinking about cutting interest rates to try to make, to reduce the pain, because effectively interest rates are a form of economic pain, particularly for those who are borrowing right now. So 5% unchanged at this meeting, and an 8-1 vote for the decision from the Monetary Policy Committee.
OK, Ed, thanks very much for that. Let's bring in Wilfred Frost, who's in the newsroom for us. And Wilf, what impact do you think this is going to have on business, and indeed what impact it's having on markets, on rates? Well,
Jane, markets celebrated around the world the fact that the Federal Reserve yesterday did that bumper rate cut of 0.5% that we've talked about earlier. The failure of the Bank of England to do a rate cut right now hasn't derailed that optimism one bit. In fact, markets have hardly flinched. The FTSE 100, if anything, has improved its performance on the day marginally. It's up 1.4% as things stand. And if we look at the futures market ahead of the US Open, that still stands very strong indeed. The Nasdaq, the tech-heavy index, is up a full 2% in the pre-market, the S&P 500 up 1.6%. And that's largely because, as we discussed with Ed coming into the decision, markets weren't really expecting a further rate cut from the Bank of England just now, so they weren't disappointed when it didn't materialise. And in general, the theme of the last 24 hours has been that all major Western central banks have now turned the corner and started to cut rates. The Federal Reserve last night was the last to do so, and in different degrees expecting more rate cuts to come. All else equal, that is seen as a positive by equity markets, but it does rest on that key point that Ed was saying. Rate cuts because inflation has gone away is a good thing for equity markets, but rate cuts because the economy is slowing and a recession potentially is on the horizon is a bad thing. At the moment, if we look at markets, they're hoping and expecting the former, not the latter.
And what about business reaction, you know, in terms of the cost of living? Any rate cuts that gives people a little bit of extra money in their pocket is something that's good for business. It's certainly good for business, for particularly mortgage holders. It is worth always remembering, though, Jane, that only about 30% of UK households own a home and have a mortgage. So it's something that we focus on immediately. And when rate cuts arrive, we had one in August, we might now have one at the next meeting, but we didn't have one today. Those mortgage holders will then, all else equal, have more money in their pocket to spend. But rents have been stubbornly high and account for about another 33% of households, with the remainder being homeowners who don't even have a mortgage. But yes, all else equal, rates coming down tends to be positive. Of course, for businesses as well, who are often largely indebted, and it will affect the interest rates they pay on their debt as well. The key thing, though, for consumers, for businesses alike, is much more the momentum in the economy than the nuance about a 0.25% rate cut here or there. Will, thanks a lot. Now, a total of 32 people have been killed following a second wave of simultaneous explosions that saw handheld radio devices detonate in Lebanon. 20 people died when walkie-talkies exploded. coming just 24 hours after 12 were killed and thousands more injured by exploding pagers. Let's take you through the latest developments across the region. Hezbollah's Secretary-General, Hassan Nasrallah, is expected to give an address at 3 o'clock this afternoon, UK time. This will be the first time he's publicly spoken about what happened this week. Lebanon's Director of Civil Aviation has banned passengers from carrying pagers and walkie-talkies on board aircraft. Israeli security services have arrested a man over an alleged Iranian-backed assassination plot on the Prime Minister, Benjamin Netanyahu. And Iran has written to the United Nations condemning the device blasts, describing them as a crime against humanity committed by Israel. Our special correspondent Alex Crawford reports.
The funerals had barely begun when there was more terror. This was Nabatea in the south of the country, yet more panic. This time at the funeral of those killed in the string of pager explosions less